Hey everyone, my name is Daniel and welcome back to another video. I hope all of you are having a great day out there. As always, here today, I want to take you all through my full fundamental analysis of Discovery stock, what is in my opinion a very undervalued, under the radar, beaten down stock that has a lot of potential post-merger with Warner Media and HBO. In this video, I want to take you all through exactly what's been going on with Discovery, why this merger with Warner Media really presents a major opportunity for them to really leverage their staying power and dominance within the video and streaming space longer term, go through some valuation and price target analysis, and exactly what I'm doing with Discovery moving forward. So if you end up enjoying this video and potentially even end up finding some value in it, please consider subscribing. And with that out of the way, let's get into it. So first and foremost, let's go through the actual business model of Discovery and Warner Media. This shouldn't really take too long as, again, they're both content creating companies. You look at Discovery. This is a company that is targeting more of a niche audience that focuses in on science and nature and animals and cooking, a variety of that type of stuff. Again, to figure out a more in-depth, or to get a more in-depth understanding into the content that Discovery creates, feel free to visit their site. Sign up to Discovery Plus. Take a look at their content, see if you like it. Now, when you look at HBO, obviously catering to a much more larger audience, or Warner Media, and this has a ton of brands surrounding it. And again, I do have an actual slide here that shows the different kind of major names that these two brands put together have. There are some major names. Again, Warner Brothers, DC, you have Harry Potter, Lord of the Rings, Looney Tunes, you have some major news networks, you have sports, so many different types of content that really fit into every single person's potential wants or interests, things along those lines. There's no doubt in my mind that these two companies will continue to dominate the fields that they're in and continue to create high-level content. Now, when you take a look at Discovery and HBO, these are both business models that, at least into the future, will be heavily reliant on direct-to-consumer, something that Netflix and Disney Plus have really mastered in a major way. You look at, in this first case, Discovery. This is a business that, first and foremost, over the past couple of decades, really relied on television. You know, again, programming or kind of running their programs through television, having people sit in front of their TV at a certain time to watch a certain show, and on top of that, watch a ton of ads and, a ton of ad breaks during that time frame. Obviously, in my opinion, this significantly limits the potential that Discovery has to really take their content and monetize it in a major way. And I think shifting over to direct-to-consumer through Discovery Plus is going to provide Discovery with a major pathway of growth over the coming years as they expand it internationally and continue to market it. So that's the growth side of Discovery. Again, leveraging their content through a subscription platform. One option, a little bit higher priced, which involves no advertisements, or one which you can actually get a lower price for that actually, has ad breaks in between. Either way, plans for everyone, allows you to watch their content on demand. You look at HBO. This is a company that has been heavily mismanaged over the past few years as they were under ownership of AT&T. Again, AT&T, they got a great business model, great company, but if there's one thing that almost everyone knows, is that they suck at investing their money into businesses and operating them on a high level. In this case, Discovery is getting a pretty sick deal, to be honest with you guys, paying significantly less than what AT&T paid for Warner Media, and on top of that, giving Discovery the potential to leverage their technology, as a lot of the technology used, the people behind the scenes, the servers, etc., can really be utilized for both Discovery and HBO. There's major growth potential here, and given just subscribers at this point in time, HBO sitting at roughly 70 million, you look at Netflix, well over 200 million, you look at Disney, Disney Plus, well on their path to right around 200 million. These are businesses that have grown substantially. I think HBO has the largest pathway of growth moving forward, given their low subscriber kind of count, at least at this point, and given the fact that international growth for HBO will be huge. I think Discovery can really unlock that potential for them. Either way, that's the business model of these two businesses. Let's go through a little bit more, some technical things before we actually go into the actual numbers here. First and foremost, Discovery stock trading under ticker symbol DISCA at around $25 per share at this point. And, you know, guys, this is a stock that has been absolutely decimated over the past roughly half year, going from right around $77 per share, getting cut in roughly 1/3 of that to roughly 25 bucks, a massive cut. And this comes off of the backing of two major pieces of news. First and foremost, you have Archegos. This is essentially a fund that owned a ton of Discovery shares. They were heavily leveraged. They weren't able to make their margin call and essentially had to sell out of a majority of their Discovery holdings, leading the stock to plummet in a major way. You also had this merger here with Warner Media, which a lot of people are skeptical about, given that Discovery is taking quite a bit of debt on to actually support this merger, which we will go into a little bit more in depth in a moment and actually factor into the numbers that I've kind of put together here. Either way, that's caused the stock price to drift down in a major way. And, you know, if you know me as an investor, I love to see a stock that has been beaten down, as a majority of the time, investors, you know, whether it be a growth stock, a hype stock, a boring value stock, whenever stocks move in a major way, it is generally an overreaction, either to the upside or the downside. If a stock is down 2/3, I want to see what's happening and see if there is an opportunity for it to rebound over the coming years, which in the case of Discovery, I think that has a lot of potential. Either way, let's go in depth into the numbers here and kind of go back and forth with this whole conversation of debt, as again, it is the major risk and one of the major turnoffs, but in my opinion, it isn't as big of a worry as one might imagine. Either way, this is the structure here today. Currently, you have Discovery with roughly $16.56 billion in equity. Again, taking their total shares outstanding, multiplying that by their share price, you get a roughly $16.5 billion company in terms of market capitalization. Now, on top of that, Discovery has roughly $15 billion of debt currently sitting on their balance sheet, giving it an enterprise value of right around $31.56 billion. Again, you take equity, add net debt, and you get enterprise value. In terms of HBO, Discovery is essentially getting HBO, but they're getting it alongside a lot of debt. In this situation, roughly $43 billion of debt will come through this merger with HBO, kind of placing the total enterprise value of the combined businesses here today at roughly $74.6 billion. That is the current valuation. And again, I generally don't use enterprise value a ton, but in the case of these two businesses, it is a must use given the amount of debt and the fact that you need to price in this debt into the valuation for this whole thing to make sense. Now, you take a look at Discovery and HBO. The ownership after this deal is completed will be that Discovery will own roughly 29% of the business, while HBO will own roughly 71%. This gives Discovery ownership of this total enterprise value of roughly $21.62 billion, and HBO, or I guess in this case AT&T, will retain 71% or $52.94 billion. Again, this is not an acquisition, this is a merger. So, with no doubt, this is a bit of a haircut compared to Discovery's current enterprise value. And again, this may be one of the major reasons as to why we've seen this massive drop-off in Discovery's stock price over the past little while. Now, when it comes to management's actual assumptions here in terms of revenue, they're guiding for roughly $52 billion in revenue by 2023. Now, this is something we can expect, at least in my opinion. Again, you look at Discovery, this is a business that has been around for decades. You look at HBO and Warner Media, a company that has been producing television shows for, or not just television shows, but movies for literally a century. These companies know what they're doing. And in my opinion, they wouldn't give out a number unless they're confident they're going to hit it. Either way, this is one of the assumptions we got to make. $52 billion in revenue, in my opinion, very likely. Now, when it comes to the actual multiple we're going to use in this situation, so again, the enterprise value to EBITDA multiple, I'm going to use 12, and this comes for a variety of reasons. Now, you take a look at Netflix. This thing's trading at, we can actually pull this up right here. You look at Netflix's enterprise value to EBITDA, and again, you can use a trailing multiple here. They're currently sitting at right around 45.5 times enterprise value to EBITDA. That's massive, right? And with Discovery, I'm only pricing in 12. Now, why is this? Discovery, again, they have a bunch of debt. And I think that does come as a risk and will be something that people may look at as a potential negative when it comes to the actual stock, the business. In addition to that, this thing's probably not going to grow revenues as significantly as something like Netflix, although they are targeting relatively high single-digit percentage gains in terms of revenue there after 2023. But you look at that, I think I'm being pretty conservative. You can also take a look at Disney, another company which has exploded over the past year in terms of stock price, generally more of a bet on their actual streaming on-demand platform than their actual parks. And I'm going to use the forward metric here as, again, Disney, they faced a lot of kind of negatives in terms of the past year here with their parks being shut down. That's extra expenses. Even on a forward basis, their current enterprise value to EBITDA multiple using 2022 estimates is sitting at 24. I'm assuming half of that for Discovery and HBO. I think I'm being a bit conservative here, but again, I'd rather be conservative than overly optimistic. And again, you got to consider the fact that, hey, this business may have a little bit more debt than Disney has. That may lead to more interest expenses. That may lead to investors lacking a bit of confidence to the valuation. Either way, I think 12 is fair. We can play around with that in a moment here. Now, when it comes to the debt to EBITDA ratio, this is something that we do have to actually emphasize on, because when we look at Discovery, post-merger with Warner Media, this multiple right here is going to be trading at, or not trading at, is going to be sitting at just around 5.5x, meaning that their total debt will be worth roughly 5.5 years of their EBITDA, right? Once they're merged, you take all of their earnings before interest, taxes, depreciations, and amortizations for the year. After roughly 5.5 years, you have the equivalent of all of their debt. That's essentially how this makes sense. And again, this did take me a few hours to actually understand on a high level just because of how complex this all looks. But again, just stay with me. I hope this isn't really too confusing here. But again, they're expecting to get this multiple down to 3. And this is big because if they can do this, this multiple may actually increase. Now, I'm going to assume this multiple is true for one main reason, and that's because Discovery acquired a company by the name of Scripps back in 2018. And they, in this kind of acquisition here, they actually took on a similar amount of debt to what we're seeing here with Warner Media. Their debt to EBITDA ratio was sitting at well over 3x. Again, that 3x is their longer term goal and was their longer term goal. What happened over the years to follow? They managed to significantly reduce their debt and get under that 3x target. This track record here with Discovery doing this just a couple of years ago, again, makes me confident that they'll be able to do it here with Warner Media. So again, we're assuming this multiple of 3x debt to EBITDA. Now the next question is, what will EBITDA be? The company is currently guiding for roughly $14 billion in EBITDA in year 2023. This assumes roughly a 27% EBITDA margin. This is a little bit lower than where they're sitting at right now, because HBO is a business that does cost a little bit more to operate. Either way, a 27% margin, roughly $14 billion in EBITDA, using this ratio here of roughly 3x debt to EBITDA, gives us roughly either $42 billion in debt by 2023. So this is down from the roughly, you can see it here, $58 billion that they're going to have in hopefully the second quarter of 2022 or thereabouts when this merger actually does finish. So you're assuming a reduction here of roughly $16 billion in debt over the next roughly 2 years, thereabouts. I think that's actually very, very achievable. Either way, now that we've gotten all of that out of the way, we can use these metrics to give us a potential valuation for Discovery over the long run. First and foremost, let's take a look at the valuation of the whole company as a whole, and then we'll divide it up into the actual ownership using the 29%. So first and foremost, and again, I'm going to repeat this because I just want to make sure I'm being as clear as possible. The long-term valuation when it comes to enterprise value will use the multiple, right? Enterprise value to EBITDA multiplied by EBITDA, right? We're assuming roughly $14 billion in earnings before interest, taxes, depreciations, and amortizations, multiplying that by 12. That's the multiple we're using. And we get an enterprise value of just under $170 million. Again, this is considering that quite conservative multiple, at least in my opinion. Now, you subtract the debt, right? Because this is enterprise value, which factors in debt. You get roughly $126 billion in equity at this moment in time. Now you divide, or not divide, you take 29% of this and you get a situation where Discovery should be trading at just around $36.6 billion in market capitalization by the end of 2023. That puts them at roughly $55 per share, or upside of just around 121%. Well over a 2x in just potentially roughly 2 years. That's significant given the shorter time frame. And this is assuming some pretty realistic multiples. Again, revenue, EBITDA, in my opinion, that will happen. But again, let's assume their EBITDA margin goes to, let's say, 25% or even 24%. Let's be a little bit more conservative, roughly $12.48 billion in EBITDA. You still get a 2x in just the next 2 years, assuming a lower margin. And I don't want to take this multiple any lower, given that it's already 50% less, or valuing the company 50% less than what it would be if we use Disney's numbers. So when you take all of these things into consideration, it's a situation where this company has a massive margin of safety over the coming years to really outperform as long as they execute. As long as these two businesses, they don't even have to grow their revenues that significantly. Let's say that they don't achieve this $52 billion in revenue. Let's say they get like $45 billion in revenue. Again, you still see upside with this stock with this ridiculously low multiple. If this multiple goes up to 14, that's where you get that situation again, using the $52 billion in revenue that they were projecting, using the 27% EBITDA multiple. You get a situation where this company has the potential to roughly 2 to 3x over the next 2 years as long as things pan out. That is my thoughts on Discovery. That is my valuation analysis. I hope that was relatively clear. If you need any further understanding, let me know in the comment section down below. I will happily answer your questions. But again, it's a situation where currently this debt is a burden to the business and to investors, as investors are worried. Their track record of reducing leverage is great, giving me the assumption that they will be able to reduce this. But hey, even if they don't reduce this, and let's say to a 5x multiple even, you still have upside in share price. You have all of these different situations where even if things don't pan out perfectly, you still see upside with the stock, which is why it is such a fascinating value proposition, right? Again, I'm not a financial advisor. I can't tell you to buy or sell a stock. I can give you assumptions and say where I think the stock may be trading at. And in this situation, I personally believe that as long as these numbers are correct, we may see, the stock trading well over 2 to 3x in just the next 3 years. Again, not financial advice. That's just my opinion. Now, when it comes to what I'm doing with Discovery stock, currently makes up right around 2% of my overall portfolio. I will probably increase this to closer to 5% as long as the stock stays trading, kind of relatively at these levels. I do like this as a low volatility, high potential stock that, gives you exposure to the streaming space without having to pay a ridiculous valuation for it. Again, if the market crashes in a major way, this company's trading at such a low multiple to where you will have limited downside. And I look at these numbers, I'm confident in the management team, I'm confident in the actual platforms and the content that they produce. I'm a believer in Discovery. Let me know what your thoughts are, but I'm a buyer of the stock and I will continue to buy as long as it's trading around these levels. Anyways, thank you guys so much for watching. I really do appreciate it. And again, let me know what your thoughts are in the comment section down below if you're buying Discovery, if you're selling Discovery, or really anything else. Anyways, thanks so much for watching, and I'll see you in the next one. Bye-bye.